Good evening, everyone. So I'm Kai from FSM. So welcome to this evening webinar, positioning your portfolio for the second half of the year. So despite signs pointing to a recession, global equities have soared instead in the first half of 2023. But are we really out of the woods yet? Investors like you and I should remain cautious as challenges are still around, and we should position our portfolio strategically for the next half of the year. With me, I have Tan De Jun, Portfolio Manager of the research team, IFA Singapore. He'll be sharing the latest market outlook while also giving us an update on our MAPS portfolio performances. Additionally, De Jun will be happy to answer any questions that you have after his presentation. So if you have any questions along the way, feel free to put them in the Q&A box, and he'll get to them over the course of this evening. So without further ado, let me pass over to De Jun to start the webinar going. De Jun, please.
Okay, thank you, Kai, and very good evening to everyone. My name is De Jun, and I am from the research team. So I'll be sharing the latest FSM MAPS portfolio updates and also our latest market outlook in this webinar. Right, so let's do a market review first. So July was actually quite a decent month for major equity indices. So in Sing dollar terms, the returns were all slightly lower across all the various segments as the HDB rose by roughly 2% against the USD over the month. Global equities returned 0.9% in the month in Sing dollar terms, and developed markets, they outperformed emerging markets, but this outperformance has actually narrowed unlike the past 2 to 3 months. And over in the US, the S&P 500 index was up by 0.7%. And this is mainly driven by bank stocks such as the likes of JP Morgan, Bank of America, and Wells Fargo, which have all performed well, supported by recent earnings growth and also the higher of further rate hikes. So US tech stocks, they also continue to do well, but the recent disappointment in earnings across some of the tech names such as Netflix, Tesla, and a few others have dampened the rally. And if we look over across the Atlantic at Europe, the stock 600 index rebounded by 0.7%, and that is helped by moderating inflation data in the Eurozone and also Chinese stimulus hopes. So the market in Europe, it rebounded despite softening in the economic backdrop as seen from falling PMIs across the manufacturing and also the services sectors. And furthermore, Europe, the outlook isn't looking good. Germany is already in recession, and the rest of Europe is actually on the brink of one. So move over to Asia. So in Japan, the Nikkei 225 returned 0.5% in Sing dollar terms. And we noted there was some profit taking in early July when the Nikkei almost hit a high of 34,000 points. So the stock market hasn't hit a little since, but it remains supported and is traded range bound as economic data such as your PMI and industry activity were still largely resilient. Now, moving on to emerging markets, Asia ex Japan returned 1.2% in July, and that is helped by China's marginal 0.5% increase, as well as decent returns from Asian heavyweights such as the likes of India and also Korea, which returned between 1.7% and 3.7%. So China's rebound, it is largely driven by the tech-related stocks as investors see the potential end of a tech crackdown and also greater government support to shore up the slowing recovery in China. So on the other hand, A-shares, they took quite a big hit as the softer than expected GDP growth numbers painted a weak recovery picture, and that has likely disappointed investors. So moving on, for Latin America, LATAM was the only loss-making market amongst the regions. However, this loss was marginal at negative 0.3% in July. So this weaker performance, it was largely driven by your Brazilian banks, which fell broadly over the month. So last but not least, we have our digital economy sector, which has continued with a strong performance, returning 4.9% in the month. So this is largely driven by the strong performance across the US tech names, and like I mentioned, more recently joined by the rally across the Chinese tech giants as well. Now moving on to fixed income. So fixed income has outperformed equities in July, and that is largely due to currency effects. So performance across most of the bond segments were largely positive. So starting with global bonds, Global bonds returned 1.7% in the month after several months of flat or to negative performance. And this comes as treasury yields across the month were lower than fell on lower than expected PCE data. So that's it. The hawkish talk by the Fed and also the expectation of a 25 basis points rate hike coming in the meeting tonight, and to a lesser extent QT, is also keeping treasury yields supported. So if you look at Asian IG bonds, they returned 0.6% in July. Credit spreads widened, driven by spread widening for Chinese IG bonds, but overall yields fell across the month. And if you look at the global high yield segment, it returned 1.8% as investors, they started to rotate back into riskier assets given the rising expectations of soft landing. So credit spreads, they continue to tighten in July, driven by spread tightening from the US high yield, whereas spreads from European high yield remain flat across the month. So Asian high yield bonds, they fell by 1.5% in July, and they were largely dragged down by the Chinese property developers. So liquidity concerns have hit several high-profile developers as of late, such as the likes of Country Garden, which is China's largest property developer, and also Wanda. And at the same time, China's property sales remains very unsupportive, with June's data seeing some of the largest monthly drops as the property woes in China continues. Now, moving on to our portfolio performance for the quarter. So as you can see from this chart over here, all our growth portfolios actually delivered positive returns in the second quarter of this year, with returns ranging from 0.6% to 4.2%. So the more aggressive portfolios did better as the risk-on market rally, which really picked up speed in June or earlier in July, continued to drive prices up. Moving on to our income portfolios, so the trend is largely the same, which all had positive returns ranging from 0.6% to 4.1%. And just like our growth portfolios, the more aggressive portfolios actually perform better. And in terms of the month-to-date performance, we delivered gains across all our portfolios as well. So over the month, we delivered returns of between 0.5% and 0.6%. However, our portfolios were, they have underperformed the benchmark. And the reason for this is that this underperformance was threefold. So number one, while we were overweight on fixed income, the performance in July was actually led by the riskier bond segments, which we have underrated. And secondly, our fixed income funds underperformed. And thirdly, our Asia and China funds also underperformed, as these are the equity allocations which we have a higher allocation to relative to the benchmark despite our underweight. And on a year-to-date basis, our portfolios have delivered returns of between 3.1% and 10%. And again, the trend is more or less the same for our income portfolios, with month-to-date gains of between 0.4% to 0.6%. And as for our year-to-date performance, they were also in a similar range to our growth portfolios, with returns of between 2.7% and 9%. So in terms of individual fund performance for our developed market equity funds, most of them have actually delivered positive returns in the month of July. So most of our DM fund picks, they managed to outperform their respective benchmarks in the month, as you can see from this table over here. So additionally, our growth and also our value funds, they have managed to do well also. So in particular, our US growth funds, like the FTGF ClearBridge US Large Cap Growth Fund, it managed to beat the benchmark by almost a full percentage point. Europe and Japan's value fund also managed to beat the benchmark by about 1%. So unfortunately, things are not as rosy for our emerging market equity funds, where most of them were loss-making and also they underperformed their respective benchmarks. Now, in terms of our tactical ideas, most of our allocations, they have managed to beat the benchmark. So global financials led the performances as bank shares jumped higher on the odds of higher further rate hikes and also the robust bank earnings, which I mentioned earlier. Next, our China tech exposure also showed some strong performance as of late, with both the iShares Hang Seng Tech ETF and also the Fidelity China Innovation Fund seeing a rise of about 3.5%. So this comes after authorities have imposed fines on tech giants, which may also be interpreted by investors as an end to their investigation process. So markets they are likely taking it as a sign that this many year-long crackdown on the Chinese tech sector is ending and are starting to become a little bit more certain on the sector's outlook. So last but not least, for our semiconductor stocks measured by the VanEck Semiconductor ETF, it has also done well this month to date, returning about 2.2% as the euphoria around artificial intelligence and semiconductors, it continues to roll on. Now, moving on to our fixed income funds. So most of our fund picks delivered positive gains in the month of July, but they underperformed the benchmark. So for our emerging market bond fund, which is the Neuberger Berman hard currency bond fund, it managed to beat the benchmark given the strong performance of Latin America bonds in July. But on the other hand, our Asian high yield bond fund, which is the BlackRock Asian high yield bond fund, it was down by 1.9%. So performance was dragged down by Chinese property developers such as likes of Country Garden, Wanda, and as debt and also liquidity issues resurface. So the next few slides will summarize some of the changes that we have made to our portfolios this year. So earlier in March, we actually increased our fixed income allocation from a rating of neutral to overweight. And in lieu of that, we have also cut our equity exposure from neutral to underweight. So we have also underweighted, and within the fixed income segment, we have also underweighted some of the riskier segments of the bond market, such as your Asian high yield, and increased our allocation to Asian IG. And on the equity side, we have actually increased our allocation to Japan while reducing our allocation to Asia ex-Japan, which is mainly dominated by the Chinese markets. So our last change was made in the month of April, where we removed the EMEA exposure via the Fidelity Emerging Europe Fund. So the reason for this removal was because the fund has actually stopped subscriptions due to the Russian assets it holds. And because of this Russian assets that the fund is holding, the issuer has actually decided to carve out a new share class for the funds to house the Russian assets while waiting for the assets to resume trading. So we have since removed the entire exposure from our portfolios, and we have redistributed EMEA's weight across the various other equity markets in their respective proportions. So moving on to our inter-asset allocation, there is no change to our inter-asset allocation at the moment. We are still underweight equities by 2.5% in exchange for overweighting fixed income by 2.5%. So similarly, there are no changes to our equities intra-asset allocation. We are currently still neutral on the US, Latin America, and China, while we are underweight on Europe as well as the digital economy. So Japan remains our heaviest overweight at the moment. And moving on to our fixed income intra-asset allocation, there are no changes here over the quarter as well. We are still overweight the safer bond segments, such as your SGD-centric bonds, global IG bonds, and we are underweight the riskier segments of the market, such as your emerging market bonds, global high yield bonds, as well as your Asian high yield bonds. So now that I've shared our latest asset allocation, I think it will be a good time to segue into our market outlook, which will probably help you understand the rationale behind our asset allocation decisions that we made for our portfolios. So investors who don't own MAPS, you may also find this useful in making adjustments to your own portfolios. Now, as we head into the second half of this year, global equity markets have performed much better than expected, despite slowing global growth, elevated inflation, and sky-high interest rates, and of course, the ever-lingering risk of a recession. So amongst the markets that are under our coverage, most of them have actually delivered positive returns year to date. And the recent rally has actually driven valuations back into expensive territory as investors are starting to ignore the risk of a recession. However, with valuations getting higher and higher, it becomes increasingly challenging to sustain such returns for the long run. And we think that investors who are planning to chase this rally, you should think twice and manage your equity exposure carefully. So looking at some of the latest economic data, I think one of the main reasons which can explain the recent market rally is the drop in inflation. So if we look across the world, almost everywhere in the world, we can see inflation falling. So Singapore, it just reported a lower headline and also core inflation for the month of June. Likewise, inflation in the UK and most of the Euro area countries have also fallen as well. And if we look at the US, headline inflation has actually fallen below core inflation for a number of months already. So although the recent inflation numbers coming out of the US is starting to indicate that things are moving in the right direction, this is partially due to the high base effect from last year. And it also masks the fact that services inflation, it remains elevated and sticky. So if we take a look at a closer look at the components within the CPI index, most of the downward movements, they can be attributed to a decrease in energy prices, which has come down significantly since the middle of last year. But as of late, we are also starting to see worrying signs that inflation could start to make a comeback. So for instance, oil prices, they have been creeping up since the end of June on the back of the supply cuts that were announced by OPEC, and also because of IEA's projection for higher oil demand. Meanwhile, if we look towards Europe, Russia recently announced that they are pulling out of the Black Sea grain deal, and that could lead to higher food prices all across the world. So more importantly, if we look beyond core inflation, we look beyond headline inflation and to core inflation, which, by the way, it is the Fed's preferred measure of inflation. Core inflation has actually barely budged and has remained well above the target level of 2%. And this only goes to show that as inflation slows, it will become harder and harder to fight. So in addition, if you look at the Atlanta Fed's sticky CPI, which is a measure of inflation for goods and services whose prices are the hardest to change, it also shows that inflation remains stubbornly high with a reading of 5.8% in June. So to give you guys some context, the Atlanta Fed estimates that in order to be consistent with the Fed's target of 2% for core PCE, sticky inflation, it has to be approximately 2.5%. And at 5.8%, it is just simply too high. So as it stands, I think everyone can see that inflation, it is still a long way from the Fed's 2% target. So moreover, if we look at shelter costs, which accounts for nearly a third of the CPI, rose by 0.6% month-on-month and 8% year-on-year in June. So in fact, home prices in the US, they have also been rising for a couple of months already, even as mortgage rates remain high. And one possible reason for this, it may be attributed to the supply-demand mismatch, as the demand for housing is actually rising faster than the new homes being built due to population expansion and also young adults leaving their family homes. And another factor that could have resulted in higher home prices is because right now there are not many people selling. Because in the US, the majority of the mortgages are actually based on a 30% 30-year fixed rate mortgage. And many of these homeowners have actually locked in extremely low mortgage rates before interest rates started rising in 2022. And because of that, many of them are actually unwilling to give up their mortgages to buy a new home and to take the new interest rate, which is why many of them are staying out of the market, leading to low supply of houses in the US. So with builder sentiment being low, home builders are also unwilling to build too many homes as they expect lower demand due to elevated mortgage rates, which could lead to lower supply available in the market. Now moving on, and another reason why inflation is so hard to quell is because of the resilient labor market, which is still seeing record low unemployment rates, strong wage gains, and also jobs growth. So in the month of June, the US economy actually added close to 210,000 jobs. And while wage growth has been falling, they are still rising at a rate of close to 5.6% year-over-year. And on top of that, if you look at the unemployment rate, it remains low at 3.6%, and that is extremely low compared to historical levels. So we also have reasons to believe that inflation, it may be structural in nature, and the world is actually moving into a new regime where structural forces will lead to a more persistent rise in inflation in the years ahead. So aside from the tight labor market conditions, as I mentioned, inflation may also be driven by other factors such as your supply-driven shortages in commodity markets and also deglobalization. So these days, many countries, they are starting to move away from fossil fuels and towards renewable energy due to environmental concerns. However, because the increase in renewable energy has not been able to keep pace with the rising energy needs of the world. Fossil fuels, they still account for roughly 80% of the world's energy needs today. But unfortunately, this green transition, it has resulted in the structural underinvestment in upstream oil and gas assets, which the supply of fossil fuels has been constrained, and that is also setting the world up for an even tighter energy market in the years ahead. So this green transition will also contribute to longer-term inflation by creating a huge boom in demand for metals that are vital to new technologies underpinning everything from electric vehicles to renewables, which the supply of which is inadequate to satisfy future needs at this point in time. So last but not least, we have geopolitical tensions, such as those between US and China, and of course, Russia against the rest of the world. This will likely result in less international trade and thus higher prices, making inflation sticky. And to fight inflation, the Fed has actually raised interest rates by 500 basis points in a span of 15 months. And while it has opted to pause its rate hikes in June, it has also raised its terminal rate forecast from 5.1% to 5.6%, indicating that there are at least 2 more 25 basis points rate hikes before the year ends. Moreover, Fed Chairman Jerome Powell, he has also pushed back against expectations of an early rate cut and has reiterated multiple times already that rates are going to stay higher for longer. So higher rates are going to slow economic activity, and this effect is likely to be more pronounced once markets start to feel the full impact of rate hikes last year. So if you pay attention to this table on the left, you can see that the current rate tightening cycle is also one of the most aggressive that we have seen since the 1980s, thus raising the risk of a recession. So next, the yield curve inversion, it also presents an ominous outlook for the global economy. So ever since the US 10-year yield fell below the 2-year yield in July last year, a US recession has been widely anticipated by markets already. So currently, the yield curve inversion, it is standing at more than 100 basis points, and it continues to show no signs of flattening out. So similarly, the 10-year minus 3-month yield curve is also at one of the steepest and longest inversions since the GFC. So when it comes to yield curve inversions, there are 2 things that really matter. The first is depth, and the second is duration. Depth referring to how deep the inversion is, and as you can see from this chart over here, the inversion is actually a lot deeper than what we have seen in the 2008 global financial crisis and also the 2001 dot-com bubble. And not only that, the yield curve has been inverted for a much longer period compared to 08 and 01 already. So recently, if we look in towards Europe, it has been declared that Germany is already in a technical recession, which is marked by 2 consecutive quarters of negative real GDP growth. And on top of that, Europe is also on the brink of one. And although the US economy has managed to sustain itself thus far, we do think that a mild recession is likely given the sky-high interest rates and slowing growth. So moreover, in the case of the US, how a recession is determined there is slightly different. So they have a committee of economists on the NBER, which determines when recessions actually happen. So, and in addition to that, they don't look at just 2 quarters of consecutive negative GDP growth. They look at other factors as well, such as the labor market, job gains, wage growth, and also other economic indicators like your PMI and other economic indicators that indicate your the broader economic activity before determining whether or not a recession is here. And to make matters worse, if you look at the US leading economic index, which is a set of metrics that are used to forecast changes in the economy before they actually happen, it continues to be on a steep decline, falling by close to 8% year over year in June. And this suggests that the economy is likely to slow even further in the months ahead. Because remember, these indicators, they are leading indicators. They are not coincident or lagging indicators. The latest ISM manufacturing PMI also came in much lower than expected at 46, which points to a faster contraction in the manufacturing sector as demand remains soft and optimism about the second half of the year weakening. Now, moving on to China. So China's economy has also lost momentum in the second quarter of this year, with GDP growth slowing to 0.8% versus a growth of 2.2% in the first quarter. as amid falling exports, weak retail sales, and of course a sluggish property sector. So all these factors that actually weigh on growth. So year on year, the economy grew 6.3% in the second quarter, and this is largely due to a low base effect from last year because many cities, including large ones like Shanghai, were still locked down for an extended period. So economic data coming out of China, it also continues to disappoint, with a notable spike in retail sales growth and a weakening property market. So China's consumer-driven recovery is also starting to show signs of losing momentum as spending slows on everything from holiday travel to cars and of course homes. So according to the National Bureau of Statistics, real estate investment is down by 7.9% year over year in the first half of the year, with commercial property sales by floor space down by more than 5% already. So earlier in June, China's exports fell at the fastest pace since the onset 3 years ago, since the onset of COVID 3 years ago, falling by 12.4% year over year, following a drop of 7.5% in May, as the global downturn it continues to weigh on demand for goods. So consequently, growth in manufacturing investment is also expected to moderate in line with cooling exports. So the Caixin Manufacturing PMI Index is slipped from 50.9 in May to a reading of 50.5 in June, as output growth and new orders are starting to soften. So China's trade situation, it is also complicated by external issues as the US seeks to put more restrictions on the export of semiconductors and also the equipment that is used to manufacture them. And I think this is actually a major blow to the ambition of China, to China's ambition of building up its own domestic semiconductor industry. And on top of that, if you look at youth unemployment, it is also at record high levels, which does not bode well for the nation's sentiment, productivity, or even the nation's future. So the difficulties facing the world's second largest economy, it will definitely put more pressure on global growth and add to calls for Beijing to step up its stimulus measures after more than 6 months, after 6 months after it abandoned its COVID-19 controls. And while the government has actually vowed to step up policy support for the ailing economy, it actually stopped short of delivering any aggressive stimulus plans. So overall, with the troubles of China, with the type of troubles China is facing, its economy it is unlikely to regain any momentum in the near term, and we continue to remain cautious on its growth trajectory this year. Now on to Japan. So Japan, as I mentioned earlier during our asset allocation, Japan it remains our greatest overweight in our portfolios at this point in time. So Japanese equities, they have been on a very good run, with domestic equity indices hitting decade high recently. So this rally has also boosted our call for Japanese equities, which we have been positive on since last year. So but despite this fierce rally, we think that Japan is one of the top equity market picks in both the near term and also the longer term. So here are some reasons why we remain positive on Japan and why we think Japan's rally has staying power. So there are a couple of reasons why we like Japan. So the first is the ongoing reopening tailwind. So Japan's tourism sector is an important part of its economy. So before the pandemic in 2019, the tourism sector contributed about 7% of the nation's GDP, which is roughly 360 billion US dollars. So to put things in perspective, this is almost equivalent to Singapore's 2019 GDP. So you can have an idea of how large Japan's tourism sector is. And ever since Japan reopened to the world last year, tourism has rebounded fiercely, shown by the chart on the left. So over the past 12 months, since April, May, there has been a massive increase of about 330% year on year in tourism spending, providing a huge boost to consumption. But despite this dramatic rebound, there is still room for tourism spending decline. So right now, it is still 90% of pre-COVID levels based on Japan's official projection, and tourism spending is expected to hit pre-COVID levels by this year. So moving on to consumption activity, which is another important driver, we find that domestic spending in Japan has stayed consistently strong throughout the past 2 to 3 years, as shown by the chart on the right. And as a matter of fact, Japan's higher inflation, it does little harm to impede domestic spending as consumption has rebounded steadily in real terms. and that is driven by a strong rebound in services spending. But more importantly, consumption activity in Japan, it is still roughly at 91% of its pre-pandemic levels, which also points to more room for further expansion. So in addition, Japanese equities, they are also supported by strong corporate balance sheets and attractive valuations. So Japanese equities, they are also not as expensive as before. Share prices are supported by robust earnings, unlike the 1980s where there was an asset bubble and share prices and valuations were sky high for Japanese equities. So last but not least, one of the other reasons that we like Japan is because the Tokyo Stock Exchange and policymakers, they have been pressuring companies in Japan with lower price-to-book ratios to more efficiently use their capital or potentially be delisted. So this campaign to improve shareholder value has been rather effective, as many companies have responded with share buybacks and also dividend payouts and improvement measures in recent months. Now, overall, on an asset class level, we continue to favor fixed income over equities, and the reason is actually pretty simple. So aside from the macro factors that I mentioned for the various markets earlier, valuations for fixed income, they are a lot more attractive relative to equities. So equity valuations, they have been pushed higher thanks to the recent rally, but bond yields, they still remain at some of the highest levels since the GFC. So that being said, if you take a look at this chart over here, it shows you the earnings minus bond yield spreads, which is also a measure between how attractive equities are relative to fixed income. And you can see that the yield spread between equities and fixed income has actually compressed to more than 2 standard deviations below the long-term average. So the lower this number goes, it indicates that fixed income, it is more attractive relative to equities. And as I mentioned earlier, the yield curve, it is also currently inverted. Therefore, in terms of duration, our preference within the fixed income space is definitely for short duration bonds, given that yields are still significantly higher compared to longer term bonds. And I think the main reason for this is that higher shorter term yields, it allows investors to actually receive higher returns without having to take on greater duration risk. And when it comes to credit ratings, we favor investment grade over high yield, as we believe that a more defensive positioning, it is important as growth continues to slow. But despite an impending recession, the yield premium of high yield bonds relative to investment grade bonds, it has not risen above its longer term average, as you can see from the chart on the left. So we believe that a high yield premium is warranted, as riskier high yield issuers, they face tougher access to credit as the macro backdrop weakens, and that paves the way for more credit spread widening. So for instance, with interest rates this high, many high yield issuers, they might have difficulties refinancing their loans, and that could lead to a higher interest expense and potentially defaults. So meanwhile, if you take a look at the spread of IG bonds, they have historically exhibited resilience since such IG credits, they typically benefit from the flight to quality in a slowing growth environment. So valuations of high yield bonds, they are also unattractive at the moment. And we believe that credit spreads are beyond the long-term average of around 600 basis points. It would provide investors with a greater margin of safety and thus a more attractive entry point. So as it stands, I'll just sum up to say that spreads, they have some room to widen before we can start to consider or start to turn positive on high yield bonds. And with that, I've come to the end of my sharing today. So this final slide over here, it shows you some of the product recommendations for the markets that I have covered earlier. So on the note of US equities, even though I have noted that the outlook remains challenging and that there are still, but we do believe that there are still opportunities around. And to that end, we think investors can consider, instead of broad-based exposure, we think that investors can actually consider quality or value tilt. And to do so, you can actually consider the JP Morgan US Quality Factor ETF for quality approach, or the JP Morgan US Value Fund for value approach. So the reasons are pretty simple. So quality stocks, they have proven to be more resilient compared to growth stocks in a recessionary environment, as quality stocks, they tend to experience a smaller earnings decline and also lower maximum drawdowns during times of market stress. So many of these quality companies, they also have stable cash flows and lower leverage, which adds to their resilience during this environment. So value stocks, on the other hand, they tend to do well during periods of high inflation and also rising interest rates. So in a rising rate environment, investors, they should look to reduce the equity duration of their portfolios by favoring stocks that derive the majority of their valuations from current fundamentals, aka value stocks, rather than those whose values actually depend on earnings in the distant future, aka growth stocks. So with that, I hope that this session has been insightful for all of you, and we still have some time before the session ends. So if you have any questions, please use the Q&A function, and I will do my best to answer all of them.
All right. Thank you, Dajun, for the sharing. So I believe a lot of people will have a lot of questions, and feel free to use the Q&A functions to ask us any questions, and we'll be more than happy to answer your questions for now. So, okay, we saw our first question. So, Dajun, do you want to take the question for this? All right, we will also wait a few more minutes, I guess, to let more questions flow in. One more thing that we want to highlight and emphasize was that we have received some feedback that the audio wasn't that ideal as we would like it to be. So we do appreciate and thank everyone for your patience and understanding, and we promise to do better for the next webinar. For now, yes, please feel free to drop in any questions that you might have, be it on the maps or the market outlook. Thank you very much.
Okay, so for the question on the Nikko AM Japan Equity Dividend Fund, okay, so how we actually select our funds at FSM is we put them through our fund selection methodology. So we have a reg funds list. So to select a fund for that particular reg funds list, we do look through things like maximum drawdown, volatility, performance, and also other qualitative factors like what the manager is, what is the track record of the fund, so on and so forth. So for this Nikko AM Japan Equity Dividend Fund, I'm not too familiar with it, so I can't give a concrete answer at this point in time. But like I said, for our fund picks, we generally look at these things as we believe that these are some of the metrics that are probably important for investors when performing fund selection. Okay, I saw a question on outlook for China's equity market. So for our outlook on China's equity market, we have actually changed our stance earlier in 2022. We think that with the current political environment in China, it is pretty hard to invest in China. So we take the tech crackdown, for instance. So this tech crackdown has gone beyond the fundamentals and has actually hurt investor sentiment with Chinese equities already. So there was a point in time where Chinese tech stocks were one of the most raved about investments in 2021, 2020. But since this tech crackdown, I think many investors have actually lost confidence in China already. And on top of that, we think that China's post-pandemic recovery, it is starting to slow already, given the government's tough stance on the property sector. So if you look at home sales in China, it has been very disappointing. People are in a way afraid to buy homes because they are wary that property developers, they may not be able to deliver them on time. Many people have also stopped, there was a point in time where many people have also stopped paying mortgages for fears that banks might collapse. So I think all in all, I think China's post-pandemic recovery is starting to slow, and the government will actually have to do more to support the economy, and not just that, help to revive investor confidence as well. And on a side note for China, if you would like to continue investing in China, I think the way to go would be to look at A shares instead of H shares. I think A shares, many of the companies that are A shares, and you can also look at companies or sectors that are more in line with government policies. So we think, for instance, semiconductors will be one. So why I say that is because the Chinese government has taken a lot of heat from the US and also its allies regarding semiconductors, and they have actually made it very clear that they want to build up its semiconductor industry so as not to be reliant on all these countries anymore in the future. So I think policies, sectors which benefit from government policies or government priorities, they are potentially some ideas that you can look at. Okay, there's another question on China. So do you see China's market recovery starting in 2024 in light of the current tensions and government measures? So like I said, I think China's outlook is quite uncertain at this point. I think my answer is pretty much the same as what I've mentioned before already. I think for China to recover, the government really has to shore up investor confidence and also get the economy going again. And moreover, I think property sector still remains one of the largest sectors in China. And with the property sector in the Dow Jones, I don't think China can recover in the near term. Okay, there's a question on will the Fed stop raising interest rates after tonight? Yeah, as you rightly pointed out, actually tonight is the second night of the Fed's meeting. So in the wee hours of tomorrow, we will know the Fed's decision. So our take is the Fed will probably hike rates 1 or 2 more times before the end of the year. But more importantly is the trajectory beyond that. So while many market participants are pricing in rate cuts already, we think that the Fed will is likely going to keep rates higher for longer. So the reason is very simple. So even though headline inflation has decreased, core inflation it still remains unacceptably high and is still very far from the Fed's 2% target. And the Fed has already stated multiple times that its mission is to bring inflation down back to its target levels. And the thing is, for an interest rate cut to occur, I think first of all, inflation it has to come down to target levels, and secondly, the economy has to show some signs of weakness at this point in time. So why I say that is because if right now, when the US economy looks to be rather healthy, labor market is still tight, why would the Fed want to risk cutting interest rates now and risking inflation returning when everything is fine? So I think a more likely scenario for a rate cut would be economic growth slowing substantially and also inflation coming down. I think these two conditions, they have to be fulfilled before you see a rate cut. Okay, there's a question on how is the MAPS performance compared to the broader market index, for instance, the S&P 500 index. So like I've shared, I think month to date and year to date, our MAPS portfolios, they have largely underperformed the indices. And this is largely because for the index, it has a weighting for our benchmark index, we use the MSCI AC World Index. And for this particular index, it has a weighting of about 50 to 60% on US equities. But unlike our portfolios, our weighting to US equities is only around 20-25%, which explains part of the underperformance. Okay, I see a question on REITs. So basically, I think the person is asking on the outlook for REITs. So I think for SG REITs, we have to be a bit more selective here. So certain subsectors may do well. Certain subsectors meaning things like your industrial REITs or your data center REITs. So these are actually supported by long-term structural trends such as digitalization and also moving into a more tech-driven world. On the other hand, we are more cautious on other subsectors like office REITs, for instance. Because nowadays, with many companies adopting hybrid work arrangements, I think the demand for office space has been trending down. So overall, I think REITs, when it comes to REITs, we have to pay attention to the interest rate environment. So right now, interest rates are pretty high. And if our prediction is right, then interest rates are going to stay higher for longer. Even though many of these REITs, they have locked in low interest rates prior to this rate hiking cycle. These low interest rates, they will one day expire, and the REITs will have to refinance at higher rates. And that's when we'll see the pain for REITs. Okay, I see a question on the US, will it go into a full recession? That's a tricky question. I can't say for sure that the US will not go into a deep recession. I think part of it also depends on how good the Fed is at looking at economic data and tailoring their response to it. So right now, I would think that a mild recession is a more likely case. So as you can see, even though the Fed has raised rates by more than 500 basis points already, the labor market still remains strong. Spending still remains pretty robust. So, and I think unlike previous recessions like in 2008 and 2001, for instance, those are actually caused by asset bubbles or credit crisis like in 08, asset bubble like in 01. So events like these, they tend to result in a deeper recession, but in the current environment that we have, it is mainly driven by higher inflation and thus higher interest rates, which tend to lead to milder recessions. So historically, inflation-driven recessions, they tend to also produce a smaller impact in terms of earnings. So you see less of an impact from inflation-driven recessions rather than credit-driven recessions like the one we experienced in 2008. I think those would be the impact on earnings per share, those would be more severe. Okay, there's a question on which sector has benefited due to high interest rates and how does tech UT or what is the outlook for technology now, I guess. Okay, so I think intuitively, one of the sectors that has benefited from high interest rates will probably be the banks. So the way banks make money is they have a really low cost of funds and they loan out based on they make loans based on market rates, which are a lot higher now. So what you observe with the three local banks, for instance, net interest margins have been rising. Many of them have been able to deliver very strong earnings growth and also share price performance. And on top of that, if you look at some of the recent earnings releases from the US banking sector, you can also see that many banks, they have actually performed quite well, better than most consensus estimates. And that is largely due to this higher interest rate environment. But the thing is, as we approach the tail end of this rate hiking cycle already, we think that the banks will likely have already enjoyed the bulk of their the bulk of the benefits coming from the rate hikes already. And if rates were to stay at this level and not go any higher from here on out, we do think that banks, their earnings growth will start to taper down to more reasonable levels. And as for the question on tech, so I think when you talk about tech, you have to be a little bit more precise. So what kind of tech you're talking about? So for instance, even though most people say that growth stocks or technology stocks, they tend not to do well during periods of higher interest rates because they're more sensitive to rates, right? But then again, we see some of the major tech names like your FANG stocks or what we call the Magnificent Seven now to perform extremely well. And I think part of the reason for that is because number one, they have a long-term growth structural growth story driving them. So semiconductors, for instance, they are driven by the AI story, and many of these tech companies, they are also doing AI. And I think the second reason has to do with fundamentals. So even though people say that growth stocks, they don't tend to do well during a recession, but then many big tech companies, they have held up well. And I think partly the reason is actually due to their strong balance sheets. So many of these big tech companies, they have extremely low borrowings, but they are flush with cash. They are net cash positive, which means that if you take their cash, you minus off all their debt, you still end up with a positive number. So I think because of these strong balance sheets, many of these big tech companies, they have managed to weather this market volatility quite well. And on top of that, many of these big tech companies, some of them, they also possess things like pricing power, which is a competitive advantage that not all companies has. So some of these big tech companies, we use their services day in, day out. We essentially we can't live without them. So I think in a way it has created a moat around the company that has helped to support these companies during times of market stress. Okay, there's a question on high yield unit. The price of high yield unit trust has stayed quite low for some time. Is it the right time to invest now? So I think I've shared earlier that now is probably still not the right time to invest in high yield stocks. Maybe I'll just go back to the slide. And I think one of the main reasons is that in terms of positioning, and because our outlook is for a mild recession to occur, so in terms of positioning, we do think that we should be favoring investment grade bonds over high yield bonds at this point in time. So more defensive positioning is definitely better in a slowing growth environment. And the thing is, despite this impending recession, if you look at the yield premium for high yield bonds relative to IG bonds, they have actually not risen above their long-term average. And we think that high yield bonds, they deserve a higher premium. As high yield issuers, they probably might face issues refinancing their loans when it comes to when the current loan expires, and that could result in some credit downgrades or credit spread widening, which would mean lower prices for high yield bonds. And I think another reason why we are not so favorable on high yield bonds is because right now, if you look at the credit spreads for high yield bonds, they are still at about below their long-term average. And we think that for high yield bonds to be attractive, the credit spreads for high yield bonds, they probably have to go beyond level of around 600 basis points in terms of their credit spreads. And that should provide investors with sufficient margin of safety. And I think that would be a point where investors can start to consider high yield bonds when spreads actually widen.
Okay. I think we are thankful for so many questions coming in, but I think we have time to only take 2 more questions. So I'll let De Jun choose the 2 questions, and then for other questions, we will keep it, and then we will answer in due time.
Okay, there's a question on currency. So what is your forecast for the US dollar versus the Sing dollar for the next 12 months? So I will tackle this question from the US dollar angle. So I think right now, one of the main reasons why the US dollar has been so strong over the past year or so is because of the rate hikes, naturally. So with high rates on government bonds and high rates on US assets, many investors, they want to buy US assets, which is why it increases the demand for the US dollar. But the thing is, as we start to approach the tail end of the rate hiking cycle already, I think the US dollar will probably stay stagnant, stay range bound, or worse, decline against the SGD. I don't think that they will experience the same kind of growth as in 2022 when the Fed was aggressively hiking rates. So that is our outlook for the USD. Okay, I see a question. Is this a good time to invest in investment grade bonds? The price has been increasing over the past few months. I think this is an exact opposite question of the high yield bond question that I answered earlier. So I would say in terms of when you look at high yield and also short duration, high yield and investment grade, I do think investment grade it will probably be a more sensible choice at this point in time. So given that high yield valuations, they are not attractive yet, as I've explained from the chart on the right, as you can see on the screen now, I think investment grade bonds will probably provide investors with better protection, especially as we head into a slowing growth environment. But aside from investment grade bonds, I think I would like to offer another idea, which is on duration. So I think short duration bonds, they are often overlooked by investors. But I think now with short duration yields reaching 5+% in the US, for instance, I think short duration bonds, they are an attractive asset class that investors should be looking at. So if you take, for instance, the latest SGS T-bill, I think the past 2 cutoff yields were around 4% or 3.8, 3.9%. I think these are pretty decent yields for a risk-free return. And the question really is, why would you want to risk your money in equities when valuations are this high for such a small amount of return, or even in high-yield bonds, when you can invest in short duration bond that can generate 4-5% returns in probably 6 months or a year. So I think in terms of relative, in terms of the risk-reward ratio, I would think IG bonds, yeah, you can consider them, or even shorter duration bonds. I think these two will be good options if you are looking for bond investments.
All right, thank you, De Jun, for the sharing, and also thank you everyone for being here. A big thank you to everyone who is here with us this evening. I really hope that you find the sharing and all the Q&A session useful in your investment journey. So just give me a moment. So on the screen are our social channels, and we invite you to connect with us. So I'll be leaving this slide on for a while. So, and with that, the webinar has ended, and have a great evening, everybody. So the recording will be up on our YouTube channel. So feel free to please scan the QR code and then follow us on our YouTube channel, and the recording will be up in a few days. So as I said again, the webinar has ended, and have a good evening, everyone. Feel free to exit the webinar, and we will see you at the next one.